What's going on YouTube? Mike here, back again with Renegade Forex, and in today's video we're going to talk about understanding risk to reward in your trading and how we can use risk to reward to kind of increase our results in our trading account, and kind of just a big picture overview of why risk to reward is so important and why saying things like, I got 1,000 pips this week, or this trade I gained 40 pips, that doesn't really mean anything, because no one, including yourself, is actually ever calculating the risk that you're taking to gain that reward. So we're going to go deep dive into understanding risk to reward in your trading today. And yeah, hopefully you enjoy the video. Before we get started, make sure you subscribe to the channel and turn on your post notifications, because I'm going to be going really in depth into a lot of valuable content over the next weeks and coming months as I launch and grow this YouTube channel, and I don't want you to miss that. So let's get started in understanding risk to reward in trading and an overview of risk to reward and kind of what that means. So first of all, when it comes to trading when it comes to risk to reward, we need to kind of separate two things. And that's one, that's how much you're actually risking on your account when you specifically open an order. So whether you're risking 1%, 2%, 5%, a fraction of a percent, whatever, that's a little bit different than what we're actually going to be talking today. We're going to be talking risk to reward in terms of like, I risked 1 unit to gain 5 units, or I risked 1 unit and I lost 1 unit, and kind of breaking that down and what that means and why it's a much more accurate measurement for what either you or the other people that you're learning from are doing and their results in their trading. And so basically why we use RR is because in one sentence, in one statement, you can then know how much you risked in order to gain that reward. So for example, if you're following a trader, or maybe your trading buddy or even yourself has learned to say, well, this trade I gained 40 pips, and you just leave it at that, there's no explanation of the risk that you're taking in order to gain that 40 pips. So if you risked 40 pips, if your stop loss was 40 pips below, and your trade went 40 pips into profit, that's really only a 1 risk to reward trade, or a 1 RR trade. And that's not impressive. It doesn't matter how many pips you gained, because you risked that same amount. And over the long term, if you're only averaging a 1 RR trade on your strategy, then you're going to have to trade a lot in order to actually break even and make a profit. And we'll go into that a little bit later on in the video in terms of like the actual numbers behind that. But yeah, it's, if you hear someone saying, well, this week I gained 1,000 pips, it sounds impressive in the beginning, but it's when you think about, well, if you risked 1,000 pips to gain that 1,000 pips, that's really not that great, because next week, if you lose 1,000 pips, then you just lost all the profit that you gained. And your strategy, when you put it in that context, the strategy is not that amazing. And saying, I gained 1,000 pips or 500 pips or whatever is not that impressive. When you hear someone say, I gained 20R or 25R or 30R or even just 5R a week or per trade or whatever, that is way more impressive, because that means that in that, if they're making 5R per trade consistently, that means that they're risking 1 unit to gain 5 units consistently on each trade. And then the results at the end of the week for yourself or for someone you're listening to or following or whatever, then become, okay, this person, has a 50 or 60 or whatever percentage of accuracy. And I know that, if they're winning, or if they're losing 40% of their trades and they're winning 60%, and their average win rate is 5R, then we can then go and break down the, how much they're losing in order to gain that reward. So hopefully that makes sense. I don't want to overcomplicate it. Basically, it's just risking 1 unit to gain X amount of units. And that just depends on your strategy and your targets and where you're taking profit. And so I just want to, like, in the beginning of this video, I just want to like bust the myth or the talk about, oh, I gained 100 pips on this trade. Well, that doesn't mean anything if you're not expressing the amount that you actually risk. Okay. And so real professional traders, most of which who trade smart money concepts like myself, will use the risk to reward measurement in order to convey our results, like in our trading journals, and for myself, like on my YouTube channel and throughout my products that I offer. And so that being said, let's go into how risk to reward affects your results in your trading, and kind of the overview of that. And so I want you to, for example, before we actually like do the math and do the numbers, I want you to picture yourself as the retail trader on the left. And on the left of the sell examples, we have a 1-to-2 risk to reward ratio trade. Okay. On the right, this is also a retail trader, which has a 1-to-2 risk to reward ratio trade. Okay, so before we actually get into the in-depth portions of calculating risk to reward and showing how that works, I figured I should at least show you the risk to reward tool that I'm referring about in case you're totally brand new to trading. Welcome to trading if you are, and if you've never, if this is like a totally new concept to you, I just want to show you how to find that tool to measure this on TradingView. So if you come over to the left side of TradingView, and you can see your drawing panel right here. And if you go to the top, you can go 1, 2, 3, 4, 5, 6 slots down, and yours will likely have something showing as this icon. Mine has the ghost feed just because I was using that previously to draw. And you can click a little bit over to the edge of that, and you can come down and you can see long and short position. Okay. And so I have these marked as a favorite, which will then mark it on my toolbar down here. And you can then click long position, for example, and add that to the screen here. Mine looks really distorted because I'm on the daily chart. And so this is like, it's showing basically 34 pips on here, but it's so far zoomed out that it looks kind of funny. But you can then take this and drag it and use this to measure risk to reward. So for this example right here, this is a 1-to-1 risk to reward ratio. And by simply moving our entry, or in other words, raising our profit level and decreasing our stop loss, we can increase the risk to reward. Okay. So in this example, if we can drag our entry down and decrease our stop loss, then that greatly increases the reward that we're gaining on each trade. Okay. And it's the same thing for selling. So if you come over here and let's just drag out our risk to reward tool, you can see as you move the entry and thereby increase or decrease the take profit level and increase or decrease the stop loss level, you can then increase your reward or decrease your risk, and or increase your risk and decrease your reward. And so I just wanted to add that in there in case you're like a totally brand new trader, and you've never understood this concept or you've never seen this before, because there was a time in my trading where I had never even understood this. I was just told, gaining 40 pips a day or whatever is, the way to make consistent profit, but that doesn't mean anything if you have to risk that 40 pips or that X amount of pips. So let's get back into the video talking about the actual, breaking down risk to reward and why and how it affects your results in trading. Okay, so when we're talking about risk to reward, it's very important to understand that high risk to reward trades are obviously, clearly more favorable than low risk to reward. And so I want to kind of dive into some examples of, low risk to reward strategies and the results that those get, and high risk to reward strategies and the results that those get. So I want you to, for example, in this scenario, I want you to picture yourself being a retail trader. Maybe you already are a retail trader watching this video, and your average win rate is a 1-to-2. Okay, so that would be depicted on the left of these sell examples right here with a 1-to-2 risk to reward. And then when you buy, it would be the same thing, obviously 1-to-2 risk to reward ratio, and that would be depicted on the right of these examples. Okay, and I want you to think for a second what that means when you win and place a trade. Okay. And, it's not really that crazy to think about, but essentially, if you win 2 trades in a row, then you are up 4R in those 2 trades. So let's say, each day you take 2 trades and you win those 2 trades for the first day, then you're up 4R. But what happens when you the next day lose 2 trades? Well, then you're minus 2R, which makes you total 2R gain for those 2 days of trading. Okay. Now, for example, let's do those same numbers and talk about how being, a much higher risk to reward ratio with your trading. And let's say, for example, you're using smart money concepts, or you're using some type of strategy that offers very high risk to reward. And you average, when you win, you average a 1 to 10 trade. So this is what that would look like in a buy, and this is what that would look like in a sell example. And let's say, keeping those same numbers, let's say the first day you take 2 trades and you do win those 2 trades, then you basically would be ahead. Well, you would be ahead 20R for the day. So you would have risked 2R to gain 20R. And let's say the next day you have a bad day of trading and you lose 2 trades, that would be minus 2R. And so for those 2 days of trading and those 4 trades you placed, you would be ahead 18R, which is obviously a very profitable strategy. And now I kind of want to help you understand, why a lot of the common issues with trading can start to happen when you have a low risk to reward strategy. And so let's go ahead, and I want to kind of elaborate on that math and then start to explain, why really high risk to reward means less trading, and why you don't need to trade as much when you have a high risk to reward trade strategy. And so I want to talk to you now about the realities of accuracy with trading and with a lot of trading strategies. Most of the time, it's very normal to be, 50 to 60, maybe if you're really good at trading, 70% accurate. And that is, to a lot of people, first of all, they can't get over that they think that they need to be 100% accurate. And I just want to tell you right now, there's absolutely nothing out there that's 100% accurate. The only thing that would be very highly accurate is a very expensive and costly trading algorithm, which I'm assuming if you're watching this video, you don't have that. And that's totally okay. You don't need to have that to be consistently profitable and to, make, to hit whatever goals you want to hit with your trading. And that's why I want to talk to you now about this idea and this concept. Okay. So when you have a really high risk to reward strategy, you don't have to worry so much about accuracy. And you certainly don't have to worry about taking a bunch of trades hoping that you come out on top. Okay. The thing that I see very commonly with retail trading strategies, regardless of what strategy it is, if you're using indicators, you're using support and resistance, you're using the patterns that retail traders trade, then they're also very low risk to reward, which makes you feel like you have to trade way more, because you are going to see very high frequency rate or amount of trades throughout your trading day. And you're going to lose one, win one, lose one, win one. And that just amplifies the need to trade more, when in reality, what you need to do is find a higher risk to reward strategy and use that in trading, and trade less and wait for higher reward setups. And so let's go ahead and break down some of the math and why it makes sense, and why risk to reward is so important in your results in trading. And so, as you can see in this numbers and this math that I just added to the top of the screen, in a high risk to reward strategy, you can come out way further ahead than a low risk to reward strategy in the same amount of trades and the same strike rate, or in other words, the same win rate. So let's say, for example, we're comparing 2 traders here. The bottom is a retail trader with, maybe you're using some kind of EMA strategy or some type of indicator that does not offer a very high risk to reward strategy or gain. And then above is an institutional trader or someone who has developed a very high risk to reward trading strategy. Even if it is a retail strategy, it has higher risk to reward than the bottom option here. And so on trade number one, trader number one with the high risk to reward gains 5R. And then trader number two with the low RR gains 2R. So the next trade, they both lose one. The trade after that, they both lose one. The trade after that, they both win. And the high RR trader gets 5R. The low RR trader gets 2R. The next trade, they win again. The high RR trader gets 5R. The low RR trader gets 2R. Then we lose one again, we lose one again, we lose one again, and then we win another one for 5R gain on the top, 2R gain on the bottom. We win another one, 5R gain on top, 2R gain on bottom. So what happens at the end of the week? Let's say, for example, this is just 1 week of trading. What happens at the end of the week with these traders when they check their results in their trading journal? Well, the high RR trader comes out with a gain of 20R. He's ahead 20R. So all in all, he lost 1, 2, 3, 4, 5. He lost 5R to gain 20R. Okay. And so that would be a very profitable trader. And if you could maintain those results, obviously you'd be, sitting very well in your trading account. And what I want to point out to you is that that's only 50% accurate. So he's only accurate, he or she is only accurate 50% of the time, but his risk to reward ratio is so high that when he wins, it sets him very far ahead in his results. And so you do not need to have 50% higher than a 50% win rate. You do not need to reach for 80, 90, 95, 100% accuracy in your trading, because if you have a higher risk to reward ratio, you come out on top because of the gains that you're gaining on your account. And so let's now analyze the lower risk to reward trader. And at the end of the week, that trader adds up their gains and they only have a total of 5R gain. Okay. And again, this is 50% accuracy. It's the same accuracy rate, but this lower risk to reward strategy is not yielding the same amount of profits that the higher risk to reward strategy is. Okay. And we're not even talking about strategy at all. We're just talking about the concept of risk to reward. And so let's say, for example, the week after this week, both traders have an absolutely horrific trading week. And let's say they both lose 6 trades. Well, the trader with the low risk to reward ratio is now negative, and the high risk to reward trader is now, instead of 20R, they would be down to 14R, which is still profit for the week. And it gives you obviously a lot more cushion in your trading, where you don't have to, you don't necessarily even have to trade every day if you don't want to, or even every week. If you have a high risk to reward strategy, you could just be placing, if 5R, if you have, imagine if you're risking 1% of your account on 6-figure balance or even a 5-figure balance, and you get 5R in your trading every week, that's an amazing amount of profit. And what are you going to do when, you start to lose that amount on a very high balance account and you start to go into profit? That's not going to feel, or into negative, that's not going to feel good for your psychology. It's not going to do your psychology any good to start to lose. If you're risking 1%, for example, you're risking 1% per trade across here, and you have a $100,000 account, that's a good amount of money that you're losing each time you take a loss. And then when you gain that too, it's not really, it's not going to be as satisfying, because you're going to feel like you need to overtrade in order to compensate for those losses. Okay. So what I'm trying to tell you, what I'm trying to convey to you, is that by having a higher risk to reward strategy, you can actually trade substantially less. You can even only trade one trade a day, or one trade a week, or whatever works for you, and still be way further ahead, and still, compound your account, a lot faster than a low risk to reward strategy. And so lastly, on this little topic, I just want to add in that there are also a lot of traders who just trade 1-to-1. And while, yes, when you do the math, having a 1-to-1 with a 60, 70, 80% win rate, whatever, that does come out to be profitable. But as a beginner trader who's watching videos like this, you're not going to be 70, 80, 90% accurate. You're going to be in this 50, 60% accuracy. Just like, myself, there's weeks where I'm way less than 50% accurate, but for the months and looking at the long term of a month, I'm 50 to 60% accurate with an average 1 to 5 risk to reward trade. And that's usually that's the minimum of what I'm targeting. And oftentimes there are higher possible reward trades. And so, yeah, that's kind of the point of what I'm trying to say here, is that if you have a higher risk to reward strategy, then you don't have to trade as much, and you definitely don't need to take more than one trade a day. Okay, and so now basically what I want to kind of summarize this with is that you need to find the balance, and you need to understand that the higher the potential reward, then the lower frequency of trades you're going to find. You're not going to find necessarily 1 to 10 or higher trades every single day. You definitely could find, a couple a week, but they're not going to be something that you find every day, where trading 1 to 1 or 1 to 2 or 1 to 3 trades, those are going to be a lot more frequent, and very frequent depending on, the time frame that you're trading. And so I would recommend finding the balance with your risk to reward in your strategy, or finding a strategy that offers higher risk to reward to better suit the type of personality that you have. So if you're someone who wants to trade 3 to 5 positions a day, then at least increase your risk to reward to, targeting a 1 to 3 or 1 to 4 or 1 to 5 rather than a 1 to 1, or 1 to 2, because when you trade 3 to 5 positions a day and you're only 50% accurate, then you're looking at stuff like this on the bottom again. So I just, to summarize this little part of the video, I would recommend you to just find the balance, not necessarily always aim for 10R if you don't know how to do that, or if you're not at a point in your trading that's realistic. Then just find the balance and learn to increase your risk to reward slowly, and manage your impulses with trading and the amount of trades that you're taking, and learn to wait for a better quality setup, and slowly increase your risk to reward. And so now I just want to paint a picture for you of why it's so important to actually risk the same amount on every single trade. And then we'll talk about how to actually physically do that inside your broker. So with these examples across the top, let's say, for example, on each of these trades, the high RR trader is risking 1% on their account, and consistently every single trade they're just sticking to 1% risk. That would mean that they're gaining 5%, then they lose 1%, lose 1%, gain 5%, gain 5%, lose 1, lose 1, lose 1, gain 5, gain 5. And so that would mean that total they gained 20% on their account. And so the RR, or the risk to reward, or when you just say R, is essentially, it's whatever X amount of percentage you're risking on your account. But for the ease of numbers, I'm just going to leave this example as 1%. And so this trader would be up 20% because they are consistently hitting high risk to reward, and they're consistently only losing 1% on each one of their trades that they lose. Okay. So the low risk to reward trader is typically someone who is, like I've said, trading a retail strategy that does not have that great of accuracy, and they themselves are just not that accurate as traders. And they have, the mentality that when I take a loss, I got to get it back and then gain some. And so they start to risk different amounts based on how they're feeling and based on their emotions that they're trading, rather than their trade plan. And so let's say for this example, on this trade, they risked 1%, and that would be a total gain of 2%. And then on this trade, let's say they risked 2% because they were getting greedy. So they lost 1, which means that they're back to break even. There's absolutely no gain here because of that, how that RR factors in. So on this trade, they get angry and they say, okay, I'm going to double up and I risk 4%. Well, when they take that loss, they're now negative 4%. Then they come back and they say, wow, I learned my lesson here. I've lost all my profits from that first trade, and I've now, gone into negative. So I'm just going to take it easy. I'm going to go back to risking 1% per trade. So they're negative 4% on their results for the week or on their account balance or however you want to factor that in. And they risk 1% to win a trade for 2R. That would then be negative 2% because they're making 2%. They're negative overall 4%. So negative 2% is their results now. Now they say, okay, I'm going to just maintain my trade plan, and I'm going to, I've learned my lesson with over leveraging and risking different amounts on each account or each trade. And I'm just going to stick to 1% again. So they risk 1% and they win again, and they win 2% total, which brings them back to zero for the week. And they have, they're totally break even. They've recovered their screw ups from back here. They've just risked 1% here and here, and now they're back at 0R gain for the week. So now we say, okay, I'm back at 0R, and I'm going to just risk 1% again. And then you lose that 1% or that minus 1R. You're now back at negative 1% on your account for the week, or on your account balance since you started it, or however you want to factor in these results here. And you're however you want to do it, you're negative 1%. So then this trader gets frustrated and they say, God, I can't seem to make any money, so I'm going to start over leveraging again, and I'm going to now risk 5% on this trade, and I'm going to hope that it goes into profit and that I can take a 2R gain. And so they're now negative 1 from this trade, and they risk 5% and they lose 1R again. But since they risked 5%, they're now negative 6% on their account. Okay. Now you can see, again, this is all of us have experienced this. I've experienced this before too. And you're going to get frustrated again, and you're going to say, okay, now I get it. I just got to manage my emotions, and I'm just going to trade 1% again, go back to my original trading plan, and I'm just going to trade 1%, and then I lose one trade again. I now have negative 7% or minus 7R on my results for the week, or on my account, or however we're factoring this. And I'm at minus 7% or minus 7R. Okay. So I then say, okay, I'm going to trade again with my 1%, and I'm going to gain 2R, which puts me at negative 5R for the week. And then I'm going to trade again with 1%, and I'm going to gain 2R, which puts me at negative 3 for the week. And so obviously the end of this becomes inaccurate when we change it. I think we said negative 3R with 50% accuracy. Okay. And that's because we're risking, different amounts on each trade. So that's why it's super important to, this is also supposed to be minus 3R. So that's why it's super important to always risk the same amount every single trade, because when you win, your wins will actually be consistent with the amount that you're losing. And that will allow you, regardless of whatever your average risk to reward is in your trading, regardless of that, then you will be consistent in your gains when you do gain them. Because obviously doing this, as we just broke this down, you're going to be over trading, and you're going to be triggering a lot of emotions and a lot of problems in your trading. So for those reasons, you always want to, regardless of whether you're the high RR trader or the low RR trader, regardless of that, you want to risk the same amount per trade. And that's kind of goes back to tying into the beginning of this, where you're just risking one unit consistently, the same amount per unit to gain, X units. So you're risking 1 unit to gain 5 units. You're risking 1 unit to gain 10 units. You're risking 1 unit to lose 1 unit, et cetera, et cetera. And so now, really quick, to wrap up this video, I just want to talk to you about how to actually risk the same amount per trade. And that's using a tool that I found extremely useful called Magic Keys. They have a digital version and a physical version of this keypad that allows you to connect to your broker on MetaTrader 4 or MetaTrader 5, and it automatically calculates the risk, or if you use a fixed lot size, it will automatically calculate that for you without you doing anything besides clicking a button. So it allows you to click a button to open these lines on MetaTrader, whichever MetaTrader platform you're using. And then all you have to do is just drag the stop loss. All you have to do, so let's say, for example, price is trading right in this zone here. All you have to do is drag the stop loss of where you want to put that, and then place your take profit, and you can either market execute at, this, wherever your entry is or wherever price is at that point in time. So let's say, for example, price trades back up into this demand or this supply zone here, and you market execute right there using the market execution with magic keys. It will just automatically factor or automatically place your stop loss, and then automatically factor your lot size based on the set risk percentage that you have for your account and for your account balance. And then you can then use the line tool to drag your take profit using magic keys and set that as well. And so if you have a strategy that requires you to take partials along the way, then you can simply drag the partial line down to, either a fixed reward ratio. If you are someone who takes profit at a 1 to 5 on every trade, you can set a partial at that 1 to 5. And if you wanted to hold to a lower target, you can do that as well. And obviously it's the same thing for buy examples. And so, yeah, that's been something that's been really game changing for me in my trading and my trading journey, is having magic keys. And it's something that I use every day. Honestly, I don't even know what lot size I trade with. It's obviously different every time because I use the risk percentage, but some days it's way bigger than others. And it's not something that I even have to think about factoring. And I know, like our example previously, I know that I'm always the top option here. I'm not risking different amounts every time. I'm not fumbling around trying to calculate my lot size manually. It's just something that is automatically done for me using magic keys. So since you stayed to the end of this video, I'd like to offer you a discount on magic keys as part of saying thanks for watching this video, and also just to, hopefully bring this tool to your attention. And if you click the links below this video in the description, so go down below this video in the description and look for my link that says magic keys, and you click that link. You have to actually click that link and then use the coupon code Renegade Forex, all one word, all lowercase. That will get you 10% off of magic keys itself. And I personally would recommend the physical version because it kind of, I don't know, to me, it kind of takes away from the point of the tool if you have to use the, find the screen that the digital version is on. But this discount code works either way for the physical or the digital version. So definitely at least check that out. If not, claim that discount code for yourself to help you take your trading to the next level. And yeah, this pretty much wraps up the video on, understanding risk to reward in trading. And hopefully you found some value in this. Like I mentioned in the beginning, be sure to subscribe to the channel, turn on your notifications, and stay tuned for the next videos.